With the high price of homes and high interest rates, many people are trying to get creative financially to help ease the pain of those high monthly payments. And people also really want to get into a home, so they're trying to find shortcuts to make it easier for them to enter home ownership. Well, I understand that may be a necessity for some people, but I'm here to tell you that some of these shortcuts are very dangerous and they could cost you a lot of money in the long run. So in this video, I'm going to share with you the 10 dangerous home buying shortcuts that you will regret. And please stick around for number 10. I feel that one is the most important one. And a lot of people have been partaking in that over the past 5 years. I don't think it's such a great idea. So stick around for that one. Of course, I'm here just to share with you the risks of doing these shortcuts. I am not saying never to do it. You know, I have to put this little disclaimer out every video that I do, but I'm just explaining to you what the risks are. I understand many of you want to just get into a home. You want to buy a home or you want to find ways to save on the monthly payments, to save money any way you can. I get it, but hear me out with these shortcuts and just please do with this what you will. Take these things into consideration. Let's start off with zero down loans. We all know zero down loans are really VA loans and USDA loans. There are some conventional loans that have a program where you don't have to put any money down, a zero down payment. Now, I want you all to be aware of what the risks are with this. Number one, when you don't put any money down on the home, you're starting off with no initial home equity. So God forbid, if the housing market took a downturn and prices plummeted, you have no equity in the house. So if you had to sell the home during a downturn, that means you have to bring extra cash to closing to pay off that mortgage. Another problem with these zero down payment loans is that you will be stuck with PMI, also known as private mortgage insurance, and that will be for the life of the loan. So you're going to have this extra monthly payment on top of the mortgage payment. That's another drawback to that. Another negative to this, to the zero down payments, is you're going to have more total interest paid, right? So you're financing 100%, meaning that you're going to be paying interest on that loan of 100%. So now in the end of the loan, you're going to be paying a lot more interest. I understand people like the idea of the zero down payment, especially for the VA and the USDA loans. I understand that. And look, I think it is a great thing, but take this into consideration if you're going to be participating in these types of loans. Okay, the number 2 shortcut, let's talk about having your parents co-sign your mortgage. If you want to be invited to holiday dinners again, I do not recommend you have your parents co-sign your mortgage with you. It is a big risk to your parents. So if you miss your mortgage payment, you default. Guess who's responsible for that? Mom and dad. Mom and dad are going to be responsible for paying that loan. If they don't, then guess what? They're the ones who are going to get sued. And you know what else happens if they co-sign that loan with you? It impacts their credit and also impacts their debt to income ratio. So it limits them on being able to borrow. So say if they needed to get a mortgage to go buy something for themselves, now their credit and DTI have been impacted because they have co-signed your mortgage. They're tied to your loan. The other biggest problem with this is it does cause a lot of family conflicts. You know, I don't care how great of a relationship you have with your parents and they're fully supportive and there's, yeah, let's do it. I'll help you out. Don't take their help. Don't. If you need someone to co-sign the loan for you, then that tells you right there, you're not ready to take on a mortgage. So don't do it. If you have to clean up your credit or save more money to put down on a house, do that first before dragging your parents into it and having them co-sign a loan. Yeah, we're not doing that. That's a really bad one. I don't recommend it. Number 3, let's talk about house hacking or bringing in a tenant to live in your house to pay your rent so you could pay your mortgage. Look, house hacking was a thing. Right? Somebody would buy a multifamily unit, and these are very popular because people could get FHA loans. You know, you could do a low down payment. You can get the house. You live on one side. You get a tenant on the other side, and that tenant's rent is paying your mortgage. Okay, I get that. But what people are doing is they're going in, they're getting approved, they're getting the mortgage, they're buying a house, and they're thinking to themselves, I'm going to be a little strapped. Let me bring in a tenant to help offset the cost of that mortgage, offset the payment. There's a big risk to that. What if that tenant loses their job? Or what if they're just a flake and they just don't want to pay their rent? Then you're screwed.
Oh, no.
You're not able to pay your mortgage. So relying on a tenant to make your mortgage payment, that's a bad idea. And it's extremely dangerous. And I would never do it. If you want to bring in a tenant, like rent out your basement, that should be for bonus money. It shouldn't be used to help pay your mortgage. We're not doing that. Please, absolutely not. That is like so super dangerous to you financially. Not worth the risk. Okay, number 4, let's talk about ARM loans, also known as adjustable rate mortgages. A lot of people are getting approved for these ARM loans, and ARM loans can be, say, 5-1, 7-1, 10-1. You've heard me talk about these loans before. These are super risky. So the way it works is that you're given a lower rate for the first, say, 5 years of the loan. Once you hit that 5-year mark, the interest rate is going to adjust to whatever the current rate is, which is typically going to be higher than what your current rate is. So 5 years paying the lower rate, then it jumps up, potentially could jump up to the higher interest rate, and then you're stuck with that unless you refinance. And then you refinance it and then you switch to a conventional loan. Now, the problem with that is if you do a 5-1, you may not have enough equity in the house in order to allow you to refinance. So if you did a 7-1, 10-1, you probably have a better chance of successfully going through refinancing and switching to a conventional. But people are getting approved for these loans and they're just going to jump in, just say, hey, I'm going to do an ARM loan instead, not thinking about the future and what's going to happen once they hit the end of that period with that lower rate. That mortgage payment is going to shoot up and then you're going to be struggling making that payment. Really shoot to get for a straight on fixed rate conventional loan. That's what I will be doing. And I know you want to go for the lower interest rates. I get it. People use this as a shortcut to get a lower monthly payment. I just don't think it's worth the risk for the lower monthly payment. If you can, save more money to put down on the house, so your monthly payments would be lower on a conventional loan. Okay, the number 5 shortcut we're going to talk about is stretching your budget to the max, meaning that you take out a loan for the full amount that you're approved for. Just because your pre-approval says you're approved for, say, $500,000 doesn't mean that that's the full amount that you're going to be spending. A lot of people do this because they're like, oh, I'm approved for this. There's a house at that price. Let me just go for it, because they want to get into a home. Again, I understand it, but you're going to be hurting yourself in the long run. Why? Because those mortgage payments are going to increase because of what? Property taxes and insurance. Those two costs will go up every year. And I know the lender is telling you, oh, your monthly payment is going to be this amount for the life of the loan. That's just a principal and interest. Your taxes and insurance are always going to increase. So if you've maxed out the amount that you borrowed, and then that over a couple of years, your payments are increasing because of the taxes and insurance, you're going to be in big trouble. You're going to be struggling. What I recommend is always go under what you're pre-approved for. Every buyer that I have worked with, that's what they've always done. They never go on the full amount that they are approved for. So just don't do that to yourself. Hey, don't forget, if you need a real estate agent in your market, whether you're selling or buying a home, feel free to scan that code there, click the link down below, fill out the forms, and I will get back to you with an agent in your area. The number 6 shortcut, working with an online lender. Now, you know how easy it is these days to just go on the interwebs, go find an online lender, put in your information, and you get pre-approved, right? And then you decide, we'll just go and use this online lender and have them do our mortgage. Okay, great. I'm not saying that all online lenders are bad, but what people do not realize, they're getting taken by the low rate that's being offered. And I've seen this time and time again. That low rate is usually a teaser rate. It's not always the rate that you're going to get, because what happens when you go through the process, you go through underwriting, something always comes up, whether it be regards to your DTI, your credit, what have you, the interest rate will actually be higher. Now, here's an example of a client I worked with probably about 3 years ago. This buyer went through one of the online lenders, Rocket Mortgage. I'm just going to say it's Rocket Mortgage. I'm not knocking Rocket Mortgage. They're not bad. But what happened in this scenario, my client did not have the best credit, but she was online. She saw Rocket Mortgage and they offered a really great rate. Okay, great. And she figured, all right, because I might have a lower credit score, they're able to approve me. Well, guess what? They approved her for an FHA loan. What happens with the FHA loan? Like I said before, with the VA loan, you have permanent private mortgage insurance. So you have an extra payment to pay that PMI every month for the life of the loan. It doesn't go away. So I connected her with my lender that I use quite a bit. He looked at her situation and he saw the debt and he saw that she had a lot of money in her bank account and said, you know what, why aren't you taking some of this money out and pay off that debt to bring up your credit score so you can go conventional? She didn't even think about that. So she did that, brought a credit score up. He was able to get her on a conventional loan for close to the same rate she would have gotten with Rocket Mortgage. And she didn't have to pay PMI because she was able to put 20% down. So this is the other issue with these online lenders. Sometimes you're not talking to a live person. They're not going to ask questions to understand your scenario to see what's the best avenue for you to help you save some money on your mortgage payment. I was so grateful that she connected with my lender and he was able to lower that payment for her and not have that PMI, which was huge. I understand that it's easy for you guys. You want to go online and you're getting sucked into these low rates and everything. Just, I would not be doing that. I'd be very leery of that. Again, I'm not knocking Rocket Mortgage. I had some deals where they did Rocket Mortgage. They're not all that bad, but you just need to be careful. You got to read the fine print and talk to different lenders and get different quotes for interest rates. There, I said it. So the number 7 shortcut that can be dangerous, using down payment assistance and not understanding the terms. Now, there's a ton of first-time homebuyer programs out there. You've heard me talk about it. Every state offers some type of program, and a lot of them offer down payment assistance. So if you qualify for that, you are given money for the down payment. It's lovely. And it's typically about 3% that they'll give you for that down payment. But what people fail to realize is that they're not reading the fine print and understanding that some cases, these are actual loans that do need to be repaid back. They do. So it's you're given that 3%. Sometimes there's a stipulation where you have to live in the home for, say, 5 years and that loan will be forgiven. Or it could just be a grant and it'll be forgiven altogether, which is great. But if you're in that situation where you have to live in a home for a period of time and then the loan's forgiven, but then you need to sell before that time period ends, you got to pay that back. You have to pay that 3% back or whatever's outstanding on it. You can't just walk away from it and say, oh yeah, that was free money. I don't owe anything. You got to make sure you read the fine print. I'm not discouraging you from looking at down payment assistance programs or any first-time homebuyer programs. It's just, this is a shortcut that people use because they don't have the money in the bank, which I get it. And I'm not knocking it, but people will do this to say, oh, I can just get money from the down payment assistance program. I don't have to worry about saving my money. If it was me, I would be saving my money. I don't care how long it takes to put my own money down because there is always that risk. If you have to sell that house before that term is up and that loan is forgiven, you're going to be stuck paying it. So just keep that in mind. Okay, number 8, this is my favorite one. Do not use this shortcut of skipping working with a buyer agent and going directly to the listing agent thinking you're going to get a better deal, okay? And you're going to not have to pay a commission. This is one of my favorite things to talk about. So when you do that and you want to go work directly with the listing agent, number 1, they're representing the seller. They're not going to represent you. So it could cost you a lot of money when it comes to negotiating the price or trying to negotiate any inspection items. That agent is working for the seller. They're not going to be doing anything for you. Now, in some cases, listing agent may come back to you and say, that's fine. I need you to sign a buyer agency agreement, and they may still expect you to pay them anyway. So I would be very careful about that. And what I would do is I would get my own representation. Work with a buyer agent. A lot of cases, the sellers are still paying the commission of the buyer agents. Everyone's thinking now, I got to pay thousands of dollars to a buyer agent. Not the case, not all the time. You don't have to pay that commission. Maybe you might have to pay a small portion of it, but you can also negotiate it with the seller. You know, if they're not paying the buyer agency commission, you can write it in your offer and ask them to pay a portion of it or the whole thing of your buyer agent. So don't assume that you're just going to go work with the listing agent and you're going to save all this money and it's going to be an easier deal for you because you're going to the listing agent. No, I would not be doing that shortcut. Number 9, draining your bank account because you paid your down payment and your closing costs, and now you have nothing left for your emergency fund. Don't do that. I've said it time and time again. Do not even start looking for a house until you have 3 to 6 months of expenses saved up in the bank. You need to have money in your bank account after you close. Do not do that to yourself. I get it. You want to get into a house and I got the money. Let's just pay it now. Let's pay the down payment. We got the closing costs. Let's just do it. You need that money in your bank account. You need an emergency fund. Please always have that money in your account, because I guarantee you, after you close, something is going to happen in the house and something is going to need to be repaired. And then if you don't have the money, then what? You're kind of screwed. So do not go into buying a house without your emergency fund. Okay, I'm glad you stuck around. So number 10, this is an important one because a lot of people have been doing this lately. Borrowing money from your 401k to use as a down payment on a house. Now, I know you're allowed to do that. With the 401k, you're allowed to borrow up to 50% or a maximum of $50,000, and you can use that towards a down payment. Now, look, a lot of people have done it and it works for them. Great. But here's the problem. If you are terminated from your job and you still have an outstanding balance of what you owe back to your 401k, guess what happens? That remaining balance will be counted as a taxable withdrawal, and you'll be subject to income tax and a 10% penalty if you're under the age of 59 and a half. This is the biggest thing that people do not understand. God forbid you lose your job. Now you have this outstanding balance. You're going to be subject to tax and penalty. That is not a situation you want to be in. Another problem with borrowing against your 401k is that you may not be able to make any new contributions until you repay that loan. Now, typically a repayment period is about 5 years. Now you're being prevented from actually making contributions to the 401k. Another issue is you're going to be missing out on money that's invested in the 401k. You're missing out on growth, your money growing in that 401k. So I understand this has been a good option for some people, and they like that. They like the idea, hey, I can borrow against my 401k, but there are risks involved with this. If your lender is trying to talk you into doing that, have that hard conversation with them about the reality of what can happen if you lost your job. Because I feel like a lot of lenders are not discussing that with them, and people are borrowing the money, and then God forbid they lost their job. Now they're stuck. They're going to be paying the taxes and the penalties. So that was a biggie, guys. That's a big, dangerous shortcut. I don't think I would be doing that. So bottom line is, don't rush to home ownership. Take your time to save your money for your down payment, your closing costs, and your emergency fund. Okay? I hope this list was helpful to you. And if you want to know what the 10 worst upgrades that you can do to your house, you can watch that video right here. Thank you so much for watching me today to get your dose of real estate reality. My name is Jackie Baker, and I will see you next time.